All right, so in this video, we're going to talk about consumer-directed health plans. So first, basically what's happening with a consumer-directed health plan is that we're putting more emphasis on the individual or the consumer to make choices. So that's kind of the big picture idea. But generally how that's accomplished is through a combination of a high deductible health plan, which I'll talk about what a high deductible health plan is in a little bit, combined with a tax advantaged savings plan, which is otherwise known as a health savings account or HSA, that can be then used to pay for healthcare. So we're going to have a high deductible plan, but we're going to couple that with a tax advantaged savings account that people can use to pay for some of those costs that they're going to have before the high deductible health plan starts kicking in. So let's talk about a health savings account or HSA. A health savings account is owned by the individual, so it's not owned by a company or your employer. It may be set up by either the individual or the employer, but it is owned by the individual. And significantly, the savings from the individual are pre-tax. So basically, they chop off some money out of your paycheck and before you ever hit taxes, and they contribute that to the HSA or health savings account pre-tax, and then you can use that to pay for qualified healthcare. So money that is paid, pulled from that HSA and used to pay for qualified healthcare is not taxed. So basically, you get to save money on taxes with whatever you're spending on the healthcare. At least it doesn't have the income taxes. Also, since they've pulled money out of your paycheck, so they've done essentially a deduction from your paycheck, it's pre-tax, and it's typically going to be sitting in an account. And if it's sitting in an account, then you may generate some savings on this account. Under current law, the savings are not actually, or the gains on the savings are not actually taxed either. So the amount of money that you pull out of your paycheck is to set aside in the HSA. You kind of avoid the income taxes, and then the money that is in the HSA, then you are getting a little bit of hopefully some interest on that, and that's not presently taxed either. Now, in some cases, employers may contribute to an employee's HSA, and those contributions are not taxable either within some limits. So there are some limits on just how much your employer could contribute to your HSA. But as long as you stay within the limits, which I won't get into in more detail in this particular recording, but as long as the employer stays within the limits, then their contributions aren't taxable either to the employee. Now, if you want to have a health savings account, in order to be eligible to have a health savings account, you have to participate in a high deductible health plan. So you're required to be a part of a high deductible health plan. So if you're thinking an HSA sounded great and you wanted to do that with your regular health insurance, it was not a high deductible health plan, sorry, that generally doesn't work. Now, significantly, the amount of money that you can set aside in an HSA is limited. So the amount of money that you can contribute is limited under law. So you can't just stash a huge amount of money in there. But you can put some money in there. And the idea is basically you're going to have the high deductible health plan, which help to capture some of the really super crazy expensive things that could occur. And then you have the HSA, which would cover the more day-to-day healthcare expenses that might occur, that sort of thing. Okay, now interestingly, for Medicare participants, because Medicare is not a high deductible health plan, Medicare participants are excluded from contributing to an HSA. However, if you have contributed to an HSA previously and there is still money there, then you can continue to use the money in that account for those qualified healthcare. So also, if you switch employers, so this is owned by the individual, but it's often sort of hosted through an employer. If you switch employers, you can potentially roll that account over into an HSA account hosted by the new employer, but you must be careful. And the reason for that is if you aren't careful, and you do this the wrong way, then the IRS could deem you to have essentially done a withdrawal for healthcare or non-qualified healthcare, and then that becomes a taxable situation. So you need to be very careful how you do it. And generally speaking, as sort of an overarching principle here, if the money goes directly from your old employer's HSA to your new employer's HSA and you never touch it, it never goes into any of your accounts personally in terms of like a checking account or anything like that. It just goes straight from the account hosted by one employer to the account hosted by the other employer. Then you're probably going to be okay. But make sure you're very careful about how you actually do it. Okay, so that brings us to the high deductible health plan. So in order to have an HSA, you have to have a high deductible health plan. So basically, a high deductible health plan is pretty much exactly what it sounds like. It is a health insurance plan with a high individual deductible. So you're going to have a lot of healthcare spending that you are going to be personally responsible for before the insurance company gets involved. And if you have a high deductible health plan as a family plan, you're going to have a high family deductible as well. And so what that means, again, is basically you are going to be on the hook for a lot more of the spending initially before your health insurance gets involved. And also typically the out-of-pocket caps, the maximum amount you could wind up spending during the year is also typically higher. So on the individual side, it tends to be higher. For a family plan, it's going to be higher. So generally speaking, kind of what we have here with the high deductible health plan is you are taking responsibility for a pretty fair amount of your initial healthcare expenses. And really what you're getting out of the high deductible health plan is if something goes really pretty badly wrong and things get really super expensive, think tens and tens and tens of thousands of dollars kind of expensive. It's going to be kicking in a lot more in that case. But if you just have a $1,000 or $2,000 medical expense, depending on the nature of your high deductible health plan, there's a good chance you're on the hook for the whole bit. And so with a high deductible health plan, if you are comfortable with basically accepting the risk associated with having basically that whole deductible level's worth of expenses and just being completely responsible for those with no contribution from insurance, then that's when the high deductible health plan can make sense. And that's why it makes sense to pair that with an HSA. So basically what you're doing in that case is you've got the plan that covers the big catastrophic stuff, and then you're taking responsibility for the lower stuff, and then you're basically coupling that with savings, so that you're setting aside money to cover basically that more mundane, somewhat more typical health expenses and things like that. Okay, now that brings us to a related concept, which is the flexible spending account, or FSA. So for the flexible spending account, this is also funded with deferred income. So basically what that means is generally we're funding this with pre-tax dollars too, typically. And this is going to be subject to contribution limits as well. So you can only set aside a certain amount for this. But basically what you can do with an FSA, or flexible spending account, is that you can use that money to pay for basically certain types of medical expenses. And it can actually be a bit more broad than for like an HSA, for instance. But you could use the flexible spending account possibly to pay for things like you need to buy another pair of glasses, or you need another pair of dentures, that kind of thing, typically, where it is some kind of healthcare kind of related thing, typically. So those are the kinds of things typically. I'd have to check on the dentures thing, but I suspect you probably would qualify. But it's those sorts of things. So you have a little bit more leeway as long as you can document that this is actually a sort of a medical expense, basically. Now with the FSA, typically the way they do this is they have you elect during the open enrollment period, typically at the end of one year, for the next year. So you make choices for the next year, and you basically set aside money every paycheck to go into this flexible spending account. Now, there's a limit to how much you can contribute, so you can contribute up to that limit, but not more. Now, what's interesting is whatever you elected, let's say you elected to set aside $500 in this FSA. Interestingly, the total amount that you have elected to contribute during the entire year has to be available to you day one. So even if you haven't actually worked through the year and therefore you haven't contributed that same amount every pay period to set aside the $500 for the year, as soon as you hit that first day of the year, if you elected to set aside $500 is available to you. And if you're thinking, well, how exactly is that available to me when I haven't paid for it yet out of my paycheck? Well, the way it's available to you is the employer basically has to make it available to you. So if you elected to set aside $500 throughout the year and you're going to be saving a certain amount every pay period, well, the employer basically has to make sure day one that the full $500 in your FSA is available. So that does pose some degree of risk to the employer, that in effect, you elect to save a certain amount and then day two of the year, you haven't really put all the money in yet, and the employer is on the hook for whatever you want to spend. So there's a little bit of risk to the employer. They can wind up paying the money out before you've actually saved it. So there's a little bit of an issue. Now, for an FSA, what's interesting is contributions that are not used during the year are lost. Now there are some little wrinkles and sort of asterisks to this one. But as a general principle, if you set aside money in an FSA, assume that if you haven't actually used it at the end of the year, that the money is going to be gone. So you want to be very thoughtful about how much money you set aside in an FSA. Because at first you're like, hey, this is great, I can set money aside. Use it for kind of a broader set of medical expenses. This is easier for me to do. It helped me pay for things with some pre-tax dollars. That's great. But the catch is, if you don't actually use it during the year, the money's gone. So now there are some little caveats to this. Okay, so couple caveats. So one caveat: there is likely to actually be a window of time after the year ends to file for expenses that occurred in the prior year. And the basic idea there is, if I incurred some medical expenses on December 31st, I may not have the full bill until sometime in January. So oftentimes there'll be a window of time there in that next calendar year where I can still file to use some of those FSA dollars from the prior year and for that prior year's medical expenses. Okay, so in other words, I had money from that FSA in that prior year. I spent it the prior year, but I just didn't get the bill until a week or two into the new year. And generally, there's a good chance that you'll actually be able to file for that and still sort of use those dollars. Also, there might be a window of time to use prior contributions for current expenses. So let's say you have some FSA money left over on December 31st, January 2nd rolls around, and you incur some medical expenses that would qualify for the FSA. And there might actually be a window of time where you can kind of claw back that money from that you set aside the prior year and actually use them for the expenses incurred in the now current year. And so you might be able to do that. Or another way that they do this, instead of having sort of that window of time, another way that they do this is to make it so that there's a limited, emphasis on limited, a limited rollover amount. So maybe the rollover amount is $300. What that would mean is if you contributed $1,000 to your FSA at the end of the year, if you have $350 still left over in your FSA, $300 of it rolls into the new year and is available for you to spend in the next year, and you lost the other 50. So ultimately, there may be a way that some of it rolls over or is available to you, or a window of time where you can still file for things from that prior year. But as a general sort of big picture principle, assume that if you put money in an FSA and you haven't used it within the year, kind of assume that it's lost. There may be some little wrinkles that you might be able to still use it, but it gets pretty restricted and pretty limited, and that's a little bit of a challenge. So ultimately, what you want to think about is what are the kinds of medical expenses that you could use FSA money to pay for, most likely. And for instance, you could use FSA money to pay the deductible amounts on your doctor visits, things like that. So your regular health insurance doesn't cover that, but if I set money aside in an FSA, I could use the FSA to cover that. So, be thoughtful about what your medical expenses will look like and roughly how much they would be, and then you can target your savings, and just be careful that you don't actually save too much if you're looking at these kinds of plans. Because with those kinds of plans, you save too much, very little of it may roll over, and you may kind of lose it. So that's kind of the challenge with the FSA accounts. It's a great concept, but you have to be a little bit thoughtful about how much money goes into it because of those wrinkles of how it actually works. All right, hopefully this discussion of some of the consumer-directed health plans and kind of how they work has been helpful. And thanks for watching, and have a great day.